này cái đến sang đi xem tờ ở địa cái thấy không? On the other side, noisy. Hi guys. So today is the second day. Today is the second day for this F6 revision. As I explained previously, today I'll be going through both individual income tax computation and corp tax computation. So if you look at these two areas, individual income tax computation and corporation tax computation, these are the two most important areas in your syllabus. Yesterday, I gave you a brief introduction to capital gains tax and inheritance tax. Both are capital taxes. Now here we are going to discuss how to calculate the income tax liability of an individual and the tax liability of a corporate, mainly a company. Now, as I mentioned at the very beginning, now these two areas are the most important areas, the bulk of the syllabus. So if you look at individual income tax computation, there are two main stages that we need to focus on. We need to first identify the taxable income of an individual. Based on the taxable income, we need to apply the relevant rates and calculate the income tax liability. Now that is a complex process compared to corp tax computation. Even in a company, ultimately we need to calculate something called taxable total profits, and on that we apply the corporation tax rate, and finally we need to find out the corp tax liability. But if you look at the income tax liability computation of an individual, it is little complex than a company, mainly because of the fact there are different thresholds that we need to apply. There are different thresholds we have to apply. And on the other hand, the rates that are applicable, they differ depending on whether they are savings income, non-savings income, and dividend income. Now, if you look at the presentation slides that has been uploaded, you'll be able to see, excuse me. Now, when it comes to taxable income computation, it consists of several stages. First of all, we need to find out the total income. For us to find out the total income, we have to identify the different sources of income applicable to that particular individual, different sources of income available to that particular individual. An individual can generate income monthly, quarterly, and annually by using different sources. The main source of income for an individual is basically employment income. In addition to that, an individual who's running a business on his own, like as a sole trader or partner of a partnership, they're entitled to receive self-employment income from an unincorporated business. If you have excess properties, you can generate rental or property business income. If you have excess funds, you can invest in a bank account where you are entitled to receive interest income, or else you can invest in shares where you can receive dividend income. When you retire, you are entitled to a pension income, depending on the pension contributions that you have made during your lifetime while you were employed or while you were self-employed. So accordingly, there are different sources of income. When you add all these sources of income together, you get something called total income. Now, this total income we have to calculate for a tax year. An individual is subject to a tax year. That is something that you can see on the screen right now. The tax year for an individual starts on the 6th of April and ending 5th of April following tax year. For your examination purposes, we have to assume that we are in the tax year 2018-19, starting on the 6th of April 2018, ending 5th of April 2019. So for this tax year, you need to find out, you need to add all the sources of income that are available, and when you add them together, you get total income. But that is not the value on which you have to pay taxes, not the total income. For you to pay taxes, still HMRC will allow you certain reliefs. You don't have to pay taxes on the total income. There are certain reliefs available, such as qualifying interest payments and trading loss relief, which is one of the most important areas in your syllabus. So accordingly, you are entitled to deduct these reliefs, such as qualifying interest payments and trading loss relief. When you deduct these reliefs from your total income, you get an answer that is what we call net income. Still, it is not the taxable income because you're entitled to deduct something called personal allowance when you're calculating your taxable income. So you see now on the screen, this is the pro income tax computation for the tax year 2018-19. You add all your sources of income together, then you get the total income. From that, you can deduct the reliefs. Then you get an important answer called net income. From the net income, when you deduct personal allowance, for the current tax year, personal allowance is 11,850. When you deduct that value, you get something called taxable income. On this taxable income only, you will have to pay income taxes. But this taxable income again can be classified under three important headings. All the students must be familiar with these three important headings. So taxable income may consist of two important incomes, such as non-savings income, savings income, dividend income. So the taxable income can be classified under three important headings: non-savings income, savings income, and dividend income. Savings income includes all the type of interest income that we receive. Then the dividend income, self-explanatory. From the name itself, you can understand when you invest in shares, then you receive dividend income. Any income which is not savings income or dividend income, they are categorized under the heading non-savings income. This includes income such as employment income, trading income, business property income, and pension income. Now, why do we have to categorize our taxable income under these three headings? It's mainly because of the fact that there are different rules we have to apply depending on the category of income. For an example, if you take savings income, there are some special rules that we must remember. They are, if your savings income or interest income falls within the first 5,000 of your taxable income, that savings income or that interest income is subject to 0% rate. I'll repeat, if your savings income falls within the first 5,000 of your taxable income, that savings income is subject to 0%. On the other hand, if you are a basic rate taxpayer, how do you identify whether you're a basic rate taxpayer or not? You look at the taxable income. If your taxable income is limited to 34,500 or less, then you are a basic rate taxpayer. If your taxable income is more than 34,500, but up to 150,000, 34,500 and 1 to 150,000, then you're a higher rate taxpayer. If your taxable income exceeds 150,000 pounds, then you're an additional rate taxpayer. You're an additional rate taxpayer. Now that is important. That is because if you are a basic rate taxpayer, out of your interest income, 1,000 pounds will be subject to 0%. We call it savings nil rate band. If you are a higher rate taxpayer, from your interest income, 500 pounds is subject to savings nil rate band. But if you are an additional rate taxpayer, then you are not entitled to any savings nil rate band. Any savings nil rate band. Now, you can see on the screen, there are some important concepts with regard to basic income tax computation. So here you can see the other rates that are applicable on savings income. So if you look at savings income, there, as I mentioned, if your savings income falls within the first 5,000 of your taxable income, then it is subject to 0% rate. And if you are a basic rate taxpayer, up to 1,000 pounds of your savings income is subject to savings nil rate band. And if you are a higher rate taxpayer, 500 pounds of your savings income, 500 pounds of your savings income is subject to savings nil rate band. But if you are an additional rate taxpayer, you're not entitled to any savings nil rate band. Then any other savings income, depending on whether you are a basic rate taxpayer, higher rate taxpayer, or additional rate taxpayer, you have to pay taxes at 20%, 40%, and 45%. Then when it comes to dividend income also, the rates are different from both non-savings income and savings income. If you have dividend income, it doesn't matter whether you are a basic rate taxpayer, higher rate taxpayer, or additional rate taxpayer, you are subject to a dividend nil rate band of 2,000 pounds. So for the tax year 2018-19, if you have a dividend income, first 2,000 pounds is subject to 0%. We call it dividend nil rate band. It doesn't matter whether you are a basic rate taxpayer, higher rate taxpayer, or additional rate taxpayer. In addition to that, if you have any other dividend income which exceeds 2,000 pounds, as a basic rate taxpayer, you have to pay at 7.5%. If you are a higher rate taxpayer, 32.5%. If you are an additional rate taxpayer, you have to pay at 38.1%. But when it comes to non-savings income, we don't have much complications. If you are a basic rate taxpayer, you have to pay at 20. If you are a higher rate taxpayer, you have to pay at 40. If you are an additional rate taxpayer, you have to pay at 45%. Then, if I may explain something about the personal allowance available. Now, that is the tax-free allowance that you have. That is a tax-free allowance that you have. However, this tax-free allowance, this personal allowance given for the tax year 2018-19 is 11,850. But if your adjusted net income exceeds 100,000 pounds, in such situations, your personal allowance will gradually be reduced. It will be reduced if your adjusted net income exceeds 100,000 pounds. So there is an important concept called adjusted net income. So how do you calculate this adjusted net income? So you can say this is how you calculate the adjusted net income. When you're doing the taxable income computation, first you arrive at the total income. From the total income, when you deduct the reliefs, you get something called net income. From this net income, when you deduct gross personal pension contributions and gross gifted donations, you get an answer called adjusted net income. So if this answer exceeds £100,000, then your personal allowance should be reduced in this particular way. So you can see on the screen there, if your adjusted net income exceeds £100,000, from that answer, you need to deduct £100,000. Say your adjusted net income is 110,000. From that, you deduct 100,000, a fixed amount, and that difference you multiply by 50%. So if your adjusted net income is £110,000, from that you deduct 100,000, you get a difference of £10,000. That into 50%, you get £5,000. Now that £5,000 you deduct from your personal allowance 11,850. So then you get a difference of 6,850. That will be the adjusted personal allowance available. Remember, either you have the personal allowance or you don't have the personal allowance at all. Personal allowance cannot be a minus figure. Therefore, if your adjusted net income, you can see if your adjusted net income exceeds 123,700 or more, if your adjusted net income is 123,700 or more, your personal allowance will be zero, because personal allowance cannot be a negative answer. So that's something to do with your personal allowance as well. So there are important concepts with regard to this basic income tax computation. So when you're doing this taxable income computation, you identify there are certain sources of income, such as savings income, dividend income, and there are special rules that are applicable on these income, as I mentioned a little while ago. But out of all these sources of income, the most important incomes are employment income and trading income. Now, if you look at the syllabus, they have allocated more and more chapters on both employment income and self-employment income. So if you look at the employment income, it consists of very important rules that you must be familiar with. And when it comes to trading income also, there is an important computation called tax-adjusted trading profit. Because for the purpose of taxation, we cannot rely on the accounting profits. We have to calculate something called taxable trading income. We call it tax-adjusted trading profit. There are certain adjustments that we need to make in order to calculate this tax-adjusted trading profit. Not only that, there are some important adjustments which are known as capital allowance computation. In addition to that, we need to identify the relevant trading income for the particular tax year given. For that purpose, we are using something called basis of assessment rules. So someone who's doing the tax adjusted trading profit computation must be familiar with tax allowance computation. He must be familiar with the basis of assessment rules applicable to an ongoing business. And a business newly started, we have something called opening year rules. And in addition to that, if we are going to cease trading, if we are going to wind up the business, then we have something called closing year rules. And then there is another important topic with regard to this self-employment income or trading income computation. There can be situations where the outcome can be a minus figure. We call it a trading loss. If you have a trading loss, then what are the reliefs available? You call them trading loss reliefs. It depends on whether it's a newly started business. Then there are several reliefs available, including something called opening year relief. If you are going to wind up the business, there is something called terminal loss relief. If it is an ongoing business, we have the carry forward relief. Then the trading loss relief against total income of the current year and or the previous year. Relief against capital gains. Likewise, there are so many reliefs available. This trading loss relief is a very important topic in your syllabus, which has been tested quite frequently at the exam. And in addition to that, on both employment income and self-employment income, we are required to pay national insurance contribution. On employment income, we have something called class 1 and we have class 1A. Class 1 must be paid by both the employer and the employee. Then class 1A is applicable only on the employer, but on behalf of their employees, when they receive non-cash benefits, they have to pay class 1A. On cash and cash equivalent benefits, the employer and the employee must pay class 1 primary and class 1 secondary. In addition to that, if you are a self-employed individual running a business on your own, such as sole proprietorship or partner of a partnership, then you're subject to class 2 and class 4 NICs. So these are the important areas in your syllabus when it comes to income tax computation. So straight away, we will look at a question that we can try from employment income and self-employment income. When you're studying for individual income tax computation, I would advise you to spend more and more time on both employment income and self-employment income. Now, if you look at employment income, we need to be familiar with both cash and non-cash benefits. How to calculate non-cash benefits such as motor car benefit, fuel benefit, accommodation benefit, a gift of asset benefit, use of asset benefit. Likewise, there are so many non-cash benefits available, and where we apply some special rules to calculate this employment income with regard to non-cash benefits. So all our students must be familiar with this non-cash benefit computations if you intend to sit for the exam in December. So I have shared certain documents with you today. Yesterday also I shared some practice questions. So from that, I would like to discuss. These practice questions. And by the way, I have shared the answers for all the practice questions that you were given, which includes CGT, IHT, COPE tax, income tax, and value-added tax. So you can see the answers also. They have been uploaded into the platform. So you can download that as well. So if you look at the practice question number 1, so this is the practice question number 1. We'll read. So we are required to calculate Rita's employment income for the tax year 2018-19. Most of the time in section C, you get questions from individual income tax computation and COPE tax computation, and there can be a 10-mark question for under trading loss relief as well. So these are highly examinable areas. So you must be familiar with employment income computation and self-employment income computation, which includes capital allowances and basis of assessment rules. Anyway, so here we are required to calculate the employment income. Now, you can read this question, and at the same time, I will explain the answer to this question. Let me get the answers. So we will look at how to calculate the employment benefit under question number 1. So kindly read the question. So while reading the question, I will explain the answer that you have been given. So Rita, who is employed as a fashion designer for Daring Designs Limited, was relocated from London to Manchester on 6th of April 2018. So she has been relocated. So she has been transferred from one office to another office. Now that can be little important, especially if this person has to incur relocation costs because she has to change her office premises. Therefore, she will have to move from one location to another location, which will include some relocation cost borne by the employer. So then there is an exemption available. So we'll look at those things. Then London to Manchester, starting on the 6th of April 2018, her annual salary is 50,910. So we have to calculate her employment income for the tax year 2018-19, starting on the 6th of April 2018, ending 5th of April 2019. So straight away, we can record her annual salary, which is 50,910, which is 50,910. So straight away, we for that value. We don't have to time apportion it because she has commenced her new employment on the 6th of April 2018. Then Rita received the following in the tax year 2018-19. She was immediately provided with a house with an annual value of 4,100, which her employer paid an annual rent of through £3,500. The house had a market value of 180,000. On 6th of April 2018, Rita was reimbursed relevant relocation expenditure of £12,000. So this is something that I mentioned, relocation expenditure. Now I'll come to accommodation benefit, but before that, we'll deal with relocation expenditure. So Rita had to change her working location, office premises. As a result of that, she had to incur certain expenses. Now those expenses have been borne by your employer. So employer has paid 12,000 as relocation expenditure on behalf of Rita. Now that is a benefit given to Rita. However, when it comes to relocation expenditure, up to £8,000 will be exempt. So here the employer has paid £12,000, which is a benefit given to Rita. However, from that 12,000, 8,000 will be exempt. Only the balance 4,000 will be taxable. So you can see relocation expenditure is 4,000 here. So how have we calculated that answer? We have £12,000. From that, £8,000 is exempt. So that is why 4,000 is only taxable, as £8,000 will be exempt. So these things you need to memorize. Now, when it comes to living accommodation, there you have to be little careful when you're calculating the living. First, we'll focus on the accommodation benefit, not the expenses with regard to living accommodation. We'll calculate the accommodation benefit. Now, when it comes to accommodation benefit, there are two charges. One we call the basic charge, the other one is something called an additional charge. How do we calculate the basic charge? If I am given accommodation, if I am provided with accommodation by my employer, and if it is nothing to do with the job that I am doing, if it is not job related accommodation, if it is job related accommodation, then it's an exempt benefit. For an example, a security officer is given accommodation that is job related. A minister is given an official residence That's job related. A hotel worker is provided with accommodation, that's job related. Those are exempt benefit. But if you're given accommodation and if it is not job related, then it is a taxable employment benefit. Now, how do you calculate that taxable benefit? It depends on whether you are provided with accommodation owned by the employer or you're provided with accommodation not owned by the employer, that is rented accommodation. Now, in this instance, the accommodation provided by the employer, the house where you have been provided with accommodation, is not owned by the company. It's a rented house. Now, in such a situation, this is how you should calculate the basic charge. It is the higher of the annual value of the property or rent paid by the employer. From the two amounts, you take the higher amount. That should be treated as your accommodation benefit. Now, in this instance, the question is very clear. She was immediately provided with a house with an annual value of 4,100, for which her employer paid an annual rent of 3,500. From the two values, which one is the higher value? The annual value of the property. Therefore, the basic charge is 4,100, which is the higher of the annual value of the property and the rent paid by the employer. Rent paid by the employer is 3,500. The annual value of the property is 4,100. So you need to take the higher value here. You need to take the higher value here. Then there is something called additional charge. There is something called additional charge. This additional charge will only arise if the accommodation provided by the employer falls within the category of expensive accommodation. Expensive accommodation. However, for you to have this additional charge, students must remember the house must be owned by the employer. It must be owned by your company, your employer. If the house is not owned by the employer, there's nothing called expensive accommodation or there's nothing called additional charge. In this instance, the house is not owned by the employer. Therefore, there is nothing called expensive accommodation. That means no additional charge applicable in this situation. If the house was owned by the employer, then you have to check whether it's expensive accommodation or not. How do we figure out whether it's expensive accommodation or not? If the cost of providing accommodation exceeds 75,000 pounds, then it falls within the category of expensive accommodation. Then you need to calculate the additional charge. But in this instance, it is not applicable as the house is not owned by the employer. Therefore, no additional charge. So students have to be very cautious. So if accommodation is provided to an employee, first of all, check whether the house is owned by the employer or not. If the house is not owned by the employer, then there's nothing called expensive accommodation or additional charge. Then only annual value of the property must be taken into consideration. Then the question says, Daring Designs Limited also incurred the following expenses in connection with the house in the tax year 1819. So not only the accommodation provided by the employer. So here Rita is provided with a house. The rent is paid by the employer. Not only the rent, the electricity of the house, gas bill of the house, water bill of the house, the council tax, everything is paid by your employer. Remember, if I am given a benefit by my employer, since I am an employee. And if there is a private use benefit to the employee, normally it's a taxable benefit. My personal electricity bill, my personal gas and water bills, my personal council tax of the house are all paid by my employer. Those are private benefits given to an employee. Private benefits, nothing to do with the job that I am performing. Therefore, these are taxable benefits. So if my electricity bill, gas, water and council tax, those are personal expenditure of Rita. If they are borne by the employer, that gives a benefit to Rita, which is taxable. So the total benefit is 7,200. Therefore, expenses connected with living accommodation, 7,200 are fully taxable in this situation. The question says further, the house had been furnished by Daring Designs Limited immediately prior to Rita's occupation at a cost of 30,000. On 6th of October 2018, Rita bought all of the furniture from Daring Design Limited for 20,000 when the market value is 25,000 pounds. Now, when it comes to use of furniture, now there you have to be little careful when you're doing the computation. So we will look at working number 2 here. Now, he has purchased certain furniture. He has purchased certain furniture. Now, the house had been furnished by Daring Designs Limited immediately prior to Rita's occupation at a cost of 30,000. On 6th of October, Rita bought all of the furniture from Daring Designs Limited for 20,000 pounds. Now, I am provided with furniture for my private use. Who has given this furniture to me? By my employer. Is it for company's use or for my private use? It is for Rita's private use. Therefore, that gives her a benefit. This is what we call use of asset benefit. This is what we call use of asset benefit, 30,000 pounds. 30,000 pounds. Now, normally, how do we calculate the benefit? The cost of furniture into 20%, that is the annual benefit. But in this instance, these furniture were bought on the 6th of October 2018. Therefore, when you're calculating the annual furniture benefit, you need to time a portion for 6 months only. So you can see here we have calculated 20% on 30,000 pounds, but have used the furniture only for a period of 6 months during the tax year. Therefore, the annual furniture benefit is 3,000 pounds for a period of 6 months. Then, if you look at then what happened was, now, if I may repeat the adjustment, the house was furniture when I occupied the premises, that is on the 6th of April 2018. When I occupied the premises on the 6th of April 2018, the property was already furnished by my employer at a cost of 30,000 pounds. Then I have been using this furniture for a period of 6 months up until 6th of October. So I used this furniture only for a period of 6 months. Then what happened was on the 6th of October, Rita, the employee, purchased all this furniture at a cost of 20,000 pounds when the market value was 25,000 pounds. So initially, for the first 6 months period, Rita didn't own this furniture. This furniture, they were owned by the company. I only had the privilege of using this furniture. I didn't have any other benefit here. I only had the opportunity of using the furniture from 6th of April 2018 to 5th of October 2018. So for a period of 6 months, I was able to use the furniture. That gave me a benefit of £3,000. Then on the 6th of October, after 6 months' time, I bought this furniture. Then Rita became the owner of this furniture. So we have to check whether there is any element of gift here. We call it gift of asset by the employer. But here in this instance, the situation is little different from a normal gift, because for a period of 6 months, I used the furniture without owning it. Then only I was permitted to purchase this furniture at a lower cost than the market value. Market value was £25,000, but I was able to purchase it for £20,000. Market value was £25,000, but I was permitted to purchase for £20,000. Then how do you calculate the benefit given to Rita by allowing her to purchase this furniture below the market value? So the rule is you have to take the greater of the market value at the time of gift, and then we do another computation to find out the available usage value of the asset, very much similar to a net book value computation in accounting. In accounting, we calculate the net book value of an asset by deducting accumulated depreciation from the cost. So here, there's nothing called depreciation in taxation, but we do a very similar computation like that. Anyway, what was the market value at the time of purchase? That was £25,000. That was £25,000. Then, when the furniture was first given to me on the 6th of April 2018, the value of the furniture was £30,000. When I occupied the premises, the value of the property was 30,000. Value of the furniture was £30,000. My company, my employer incurred 30,000. Then I used this furniture for a period of 6 months. As a result of that, the value of the furniture reduced by £3,000 during that 6 months period, as we calculated here. So on the 6th of April 2018, my employer paid 30,000 to buy furniture. Then for a period of 6 months, the value was reduced because I used the furniture, and the usage value of the furniture we have already calculated here, that is £3,000. So that £3,000, the same value £3,000, you deduct here. Then the current available usage value, that's why I said it's like cost minus accumulated depreciation, and you get the net book value. So somewhat similar to that. So the available usage value of the property is now how much? £27,000. Market value is £25,000. Market value is £25,000. Available usage value is £27,000. From the two amounts, you have to take the greater value. So if you decide to take the greater value here, you must go ahead with £27,000, because it's greater than the market value. So my benefit is £27,000 then. But these furniture, they are not given to me free of charge. I still had to pay something. How much I had to pay to buy this furniture? Rita had to pay how much? £20,000. So from £27,000, which is the greater value, you deduct 20,000. then you get a difference of 7,000. So here my benefit is 7,000 pounds. This is the amount that will be taxable. This kind of adjustments are quite common at the exam. These examples are quite common at the exam. Therefore, we must be familiar with this kind of adjustments. Now we'll read the balance part so you can see. Use of furniture benefit. Now we have calculated 3,000 pounds. And then purchase of furniture gave us a benefit of 7,000 pounds. 7,000 pounds. All right. Then read the next adjustment. On 6th of April 2018, Rita was provided with a laptop computer which cost 1,500 and a smartphone which cost 300 pounds. Both were provided for her personal use. So if I am given something for my personal use, normally it's a taxable benefit. But if I am given something to perform my duties properly as an employee, that doesn't give me a benefit. So I have no reason to pay taxes. But if I am given an asset or some other benefit for my private purposes by my employer, in that case, I need to pay taxes on that unless it is an exempt benefit. So I am given two assets here. One is a laptop, the other one is a smartphone. Remember, if I am given a smartphone or any other phone, the first phone given to me is an exempt benefit on which I don't have to pay taxes. So I am given a smartphone for the first time. This is the first phone that I am given. If I am given a second phone, then I have to pay taxes on that. But the first phone is exempt from taxes. Therefore, it's an exempt benefit. So for the smartphone, I don't have to pay anything. However, for the laptop computer that I am given, it's a gift. It is given for my private use. I'm sorry, it is given for my private use. So that was given on the 6th of April 2018. This is what we call again use of asset benefit. How do you calculate the use of asset benefit? Cost of providing the asset into 20% if I have used the benefit throughout the tax year. Here the laptop was given on the 6th of April 2018. Throughout the tax year, I have used the laptop. Therefore, it gives me a use of asset benefit equivalent to 20% of 1,500. So take 1,500 into 20%, you get the answer 300 pounds. You get the answer 300 pounds there. Okay. Smartphone, as I said, it is an exempt benefit on which I don't have to pay any taxes. Okay. Then look at the next one. Daring Designs Limited had made a loan to Rita in 2015 of 12,000 pounds at a rate of interest of 1.5% per year. The loan is not being used for a qualifying purpose. No part of the loan has been repaid. Okay. Now this is what we call beneficial loan benefit. If an employer has given me a loan for my private use, if my employer has lent me money for my private use at a concessionary interest rate, that gives me a benefit. Now, how do we determine whether it is at a concessionary rate or not? For that, we need to consider something called official rate of interest. Official rate of interest. So if my employer has lent me money below the official rate of interest, that gives me a benefit. It's not lending money which gives the benefit. It is lending me money below the official rate of interest is what that gives me the benefit here. So official rate of interest for the tax year 2018-19, it's given in the tax table. Currently, it's 2.5%. Currently, it's 2.5%. So if I have been able to borrow money from my employer below 2.5% interest, that gives me a beneficial loan benefit. That gives me beneficial loan benefit on which I must pay taxes. Now, to calculate this beneficial loan benefit, there are two methods that we are using. One we call the precise method or the actual method. The other one is what we call the average method. So by using the two methods, you need to calculate the beneficial loan benefit, and then you need to determine the lower amount, and you can pay taxes on the lower value. But in this instance, you need to use little bit of common sense as well. In this instance, the question clearly says that Rita hasn't paid any part of the loan during this time period. She has not paid any part of the loan during the time period. Therefore, remember, even though you use the precise method or the average method, you will still get the same answer. Therefore, you don't have to do two separate computations using the precise method and the average method. Whatever the method that you use will give you the same value. If you want, you can do two separate computations and see, but you will get the same answer in this situation. Anyway, now how much is the loan given? So you can see the loan benefit computation. We'll look at the computation there. Loan benefit. So 12,000 is the value of the loan that is given. 12,000 is the value of the loan given. If I am going to borrow from outside, I have to pay at least 2.5%. This is what we call the official rate of interest. 2.5%. But I am paying only 1.5%. Therefore, it gives me a benefit of 1% on 12,000. I haven't paid any part of the loan. So on the full 12,000, my benefit is 1%, which is 120 pounds. Therefore, I need to pay taxes on these 120 pounds. Which gives me a taxable benefit. So you can see 120 pounds here. Then we'll read the balance part of the question. Rita was provided with a company car. It had a list price of 18,500 when new in August 2016 and has a carbon dioxide emission rating of 142 grams per kilometer. Daring Designs Limited paid for the petrol for all the mileage traveled by Rita until 5th of December 2018. So these dates are important because at the end of the day, you need to calculate the benefit only for the time period that you have enjoyed the benefit. So if you have not enjoyed the benefit throughout the tax year, you must be cautious to time apportion the benefit. Now here, there are two benefits given. One is Rita is provided with a car, not only for her job related work, but for her private use as well. So she's given a car for her private use as well, which gives her a taxable benefit. Now, how do we calculate this car benefit? Excuse. Car benefit is calculated by applying the relevant appropriate percentage, by applying the appropriate percentage on the list price. You have to apply the appropriate percentage to the list price. List price is given in the question, which is 18,500. We only have to calculate the appropriate percentage. In order to calculate the appropriate percentage, relevant guidelines are actually given in the tax table as well. So you need to use the tax table in order to find out the appropriate percentage here. Now that depends on the carbon dioxide emission of the vehicle. So when you're calculating the car benefit, what you have to look at is whether it's a petrol driven car or diesel driven car. Now here, it's a petrol driven car. At the exam, you're given rates for a petrol driven car. If you want to convert into a diesel driven car, you do a normal computation, and to the last answer, you can add 4%. That will give you the percentage for a diesel driven car. However, petrol or diesel, the appropriate percentage cannot exceed 37,000 pounds. Remember, it cannot exceed 37,000. I'm sorry, it cannot exceed 37%. Whatever the appropriate percentage that you get here, petrol or diesel, it cannot exceed 37%. Anyway, now this is a petrol driven car. Accordingly, if the carbon dioxide emission is 95 grams per kilometer, exactly 95 grams per kilometer, then the relevant percentage is 20%. However, according to the question, carbon dioxide emission is more than 95%, 95 grams per kilometer. It's 142. Then what you're supposed to do is round it up to the nearest multiple of 5. You need to round it up to the nearest multiple of 5. So we'll see the way that we have done the computation. So you can see in this instance, you need to be careful. I must correct myself. I made a small mistake here. You need to always round it down to the nearest multiple of 5. You need to round it down to the nearest multiple of 5 all the time. I need to correct myself. So round it down to the nearest multiple of 5. So here 142 grams per kilometer. So round it down to the nearest multiple of 5, that is 140. Let's say you get 144, still you round it down to the nearest multiple of 5, which is 140 grams per kilometer. So 140 minus 95, that difference must be divided by 5. This is how it works. Up to 95 grams per kilometer, appropriate percentage is 20%. If the carbon dioxide emission exceeds 95 grams per kilometer, for every 5 grams in excess of 95, you need to pay extra 1%. You need to add extra 1%. So if the carbon dioxide emission exceeds 95 grams per kilometer, for each 5 grams per kilometer, you have to pay extra 1%. So round it down to the nearest multiple of 5, take the difference between 140 and 95, that difference you divide by 5, add it to 20%. So you can see for a petrol car, if it is exactly 95, it's 20 grams per kilometer. Round it down to the nearest multiple of 5, you get 140. Take the difference between 140 and 95, divide by 5. The answer is 9. You add it to 20%, then the appropriate percentage is 29%. So apply this 29%. Apply this 29% on the value of the car, which is 18,500. 18,500, 29%. But don't forget, this benefit was given to Rita only up until 5th of December 2018. 5th of December 2018. So the car was given on the 6th of April 2018, and the benefit was given only up until 5th of December 2018. That is actually for a period of 8 months. So when you multiply by 29%, the answer is the benefit for 1 year, but you haven't enjoyed the benefit throughout the tax year. You have enjoyed the benefit only for a period of 8 months. Therefore, you need to time apportion it. You need to time apportion it. Accordingly, the car benefit is 3,000. Car benefit is 3,577. At the same time, you can calculate the fuel benefit also, because Rita has been given not only the car for her private use, even for her private journeys, the employer has provided petrol for her private journeys, which gives her a personal benefit. There, when you are calculating the fuel benefit, remember, you have to apply this fixed figure of 23,400, which is given in the tax table. So apply the same percentage we calculated here. Apply the same percentage we calculated here, 29%. On the fixed figure 23,400, and again, this benefit was not provided to you throughout the tax year. It was given to you only for a period of 8 months. Therefore, the benefit must be time apportioned for a period of 8 months, which gives you 4,524. Accordingly, your car benefit is 3,577. Fuel benefit is 5,424 pounds. Then we'll read the latter part of the question. On 5th of December 2018, the company discontinued the company car scheme and sold the car to Rita for 5,000 pounds, its market value at that date. Remember, normally when you purchase a car, it gives you a benefit. Normally when you purchase an asset below the market value, it gives you a benefit, but that calculation is not applicable to motor cars. So you don't have to do anything for purchase of the motor car below the market value. Now, earlier we did a computation where we had to calculate the benefit when we purchase furniture below the market value. But that computation is not applicable when you purchase a motor car, so you can completely ignore it. However, her mileage, now they discontinued the car scheme. Instead, Shiva has been given a different option now. Her mileage from 6th of April 2018 to 5th of December 2018 was 20,000, of which 13,000 was on business. Now, her mileage from 6th of April 2018 to 5th of December 2018 was 20,000, of which 13,000 was on business. Then adjustment number 5, it says from 6th of December 2018, Rita traveled 11,000 miles for business purposes in the car that she had purchased from the company. The company reimbursed her 45 pence for each business mile. Now there you have to be really careful. Now from 6th of April 2018 to 5th of December, she was given a car by her employer. She was given a car by her employer. She was given a car by her employer. Now, during that time period, you didn't use your own car. You used the car that was owned by the company or that was owned by the employer. That doesn't give you any that doesn't allow you to do any approved mileage allowance computation. There is something called approved mileage allowance computation. Approved mileage allowance computation, AMA. Now that computation we do when an employee uses his or her own car for the purpose of business, for the purpose of employment. If I am using my own car for the purpose of employment for business journeys, then HMRC allows me to claim something called approved mileage allowance. Now 6th of April to 5th of December, I didn't have my own car. It was owned by the company, by the employer. Therefore, I'm not entitled to claim any approved mileage allowance. But then what happened was on the 6th of December, I bought this car for myself. Now I own a car and I am using my own car for business journeys from 6th of December to 5th of April 2019. I have traveled 11,000 miles for business purposes. Since I am using my personal car since 6th of December 2018, I am entitled to claim approved mileage allowance on this 11,000. How do we calculate it? The rates are given at the exam. First 10,000 miles, I can claim 45 pence for each mile. Anything in excess of 10,000 miles, for each mile, I can claim 25 pence. So you can see, first 10,000 miles for each mile, 45 pence, 4,500. Anything in excess of 10,000, I can claim 25 pence per mile, 1,000 into 25 pence, that is 250. So altogether, the approved mileage allowance is 4,750. But don't forget, when I'm using my own motor car, my employer pays me something when I'm using my car for business journeys. When I'm using the car for business journeys, my employer pays me something. How much he's paying? For each mile, he's paying 45 pence as mentioned in the question. So I have done 11,000 business miles. For each mile, he's paying 45 pence. That means he has actually paid me 4,950. But my approved mileage allowance is 4,750. It means, it indicates that my company, my employer has paid more than the approved mileage allowance, which is 200 pounds. I'm entitled to claim an approved mileage of 4,750 when I'm using my own car for business journeys, but my employer has already paid 4,950 more than the approved mileage allowance of 4,750, which gives me a taxable benefit. Therefore, I must pay taxes on the excess 200 pounds because my employer has paid more than the approved mileage allowance. So that is also a commonly tested adjustment at the exam. So we must be familiar with these things. So you can see mileage allowance here is 200 pounds. 200 pounds as we have already calculated. Then one more thing. During the tax year 2018-19, Rita was provided with a place in Daring Designs Limited workplace nursery for her daughter at a cost to the company of 1,200. Workplace nursery provided to all the employees of the company is actually an exempt benefit. So you can see the provision of workplace nurseries for childcare is an exempt benefit. Therefore, you don't have to pay taxes on that. Then when you add everything together, you can see my non-cash benefits are mainly 34,000, 34,021. My salary is 50,910. My employment income is 84,931. So this is how you calculate the employment benefit for an individual. So all these are commonly tested adjustments at the exam, and a student must always be familiar with these benefits. So in a nutshell, you must be familiar with non-cash benefit computation such as accommodation benefit, car benefit, fuel benefit, beneficial loan benefit, use of asset benefit, gift of asset benefit. So these are the commonly tested ones at the exam. Now we will look at another question from trading income, tax adjusted trading profit computation. Now, as an individual, your main income can be either from employment or from self-employment. So if you are self-employed, in that case, you are entitled to a trading income. You are running a business on your own as a sole proprietor, or else you might be a partner of a partnership. In any of these situations, when you are running an unincorporated business, the income of the unincorporated business should be taxed on the owner of the business. So we look at question number 2. Tony, note, please read that question. So again, we can look at the answers for that question. So this is the answer for the second question. So we will look at the adjustments that we have been given. Tony Note is self-employed, running a music shop. So we'll first read the required part. Always start with the required part, then you know what you're supposed to do. Calculate Tony's tax-adjusted trading profit for the year ended 5th of April 2019. Your computation should commence with the net profit figure of 169,430 and should list all the items referred to in notes 1 to 8, indicating by the use of 0 any items that do not require any adjustment. Okay. Now, the guidelines are given. We need to stick to, we have to strictly comply or adhere to the guidelines that we have been given. So if you comply with these guidelines, we can easily score full marks for a question like this. Now here, we have to start our computation with the net profit figure of 169,430. So net profit figure of 169,430. So that is an instruction, piece of instruction given in the question. Now what we have to look at is, what we have to do is, you go back to the question and see how Tony Note has run his business, is self-employed running a music shop. So it's a music shop. So be familiar with the nature of the business as well. Sometimes it might be useful, we'll say. His statement of profit or loss for the year ended 5th of April 2019 is as follows. Starting with the gross profit. Since we have already started our computation with the net profit, which already includes the gross profit figure, we can ignore the gross profit when calculating the answer. We can ignore it. So then the gross profit, just ignore it. Then starting from the expenses, we have to consider one by one the items that are given in the income statement. Take one by one and we'll do the computation. So here, expenses, the first item is depreciation. Now, what we are trying to do here, I'll briefly explain. This is the accounting statement. This is an accounting statement. This gives us the accounting profit. But for the purpose of taxation, we cannot rely on the accounting profit. We have to calculate the taxable profit. In doing that, there are certain expenditure which are not allowable expenditure for the purpose of taxation. Most of the expenditure are permitted for both accounting and for tax purposes, but there are certain expenditure they are allowed for accounting purposes, but they are not allowable deductions for the purpose of taxation. Whereas there are certain expenditure allowable deductions for the purpose of taxation, but not allowable for accounting purposes. Therefore, we have to do necessary adjustments in order to calculate the tax adjusted trading profit. Likewise, we have to do a similar computation, similar adjustments when considering income. There are only income for the purpose of accounting, but not taxable income. Then we have to ignore them. There are certain income, they are taxable and they are relevant even for the purpose of accounting. So then you don't have to do anything. Even for accounting, it's an income. For taxation also, it's an income. Then you don't need to do any adjustment. But there are certain income, they are only taxable for the purpose of taxation, not for accounting. Then you need to take them into consideration. So the relevant adjustments must be done mathematically to find out the answer here. It's very much similar to a cash flow statement prepared by using the indirect method. So when you are using the indirect method to prepare a cash flow statement, we do similar adjustments, that is purely to identify cash inflows and outflows. Here it's not the same, but mathematically we have to use a similar approach here to get the answer. Anyway, so we will see whether there are expenditure not allowed for the purpose of taxation. If there's any expenditure not allowed for the purpose of taxation, we can't deduct them, we need to reverse it. To calculate the accounting profit, if they have already deducted it, but if the taxation says no way you can't deduct it, it's not an allowable deduction, then we need to reverse it by doing the opposite. Expenses in accounting we deduct, but for the purpose of taxation, if it is not deductible, you need to reverse it by adding it back. Best example is depreciation. Depreciation is only a concept recognized in accounting. It's not a concept recognized in taxation. Therefore, depreciation must be reversed. You cannot take depreciation into consideration. You must add it back. So 2,640 depreciation you need to add back. Then motor expenses. Motor expenses you need to look at. For that you have to look at note number 1. So when there is a note given, straight away refer to the relevant note. During the year ended 5th of April 2019, Tony drove a total of 20,000 miles, of which 2,500 were driven when he went on holiday to Europe. The balance of the mileage is 20% for private journeys and 80% for business journeys. Okay, so the total mileage done is 20,000 here. But from that, 2,500 he has done for his private purposes when he went to Europe on a holiday. Therefore, from this 20,000, from this 20,000, 2,500 is for private purposes. Then you get a balance of 17,500. 17,500. From that 17,500, again 20% for private journeys, 80% for business journeys, which is 14,000. So 80% for business journeys, 20% for private journeys. Now, I need to find out the traveling that I have done for the purpose of business, because it's related to the business that I am doing, the trading that I am doing. Therefore, it's an allowable expenditure. So 14,000 miles I have done for business journeys out of 20,000. So you would see my motor expenses are 9,800. My motor expenses are 9,800. 9,800. From this 9,800, I have done for 20,000 miles. I have done it for 20,000 miles. I have done it for 20,000 miles. But from that, the business mileage is only 14,000. So 9,800 divided by 20,000 multiplied by 14,000. That is the allowable amount that I can deduct as an allowable expenditure. But you would notice out of this 20,000, 6,000 in total I have done for my private journeys. I have done for my private journeys. So 9,800 divided by 20,000 multiplied by 6,000. The answer that I get there is not allowable expenditure, because it's purely for private journeys. Since it is for private journeys, I cannot take that value. I need to reverse it. So 9,800 divided by 20,000 multiplied by 6,000. As a percentage, it's 30%. They are disallowed. So 9,800 into 30%, it's disallowed. I need to add it back, 2,940. Then go to the next item, professional fees. Professional fees, 4,680. There's a note given. So we'll see what are the professional fees that we are having. The figure for professional fees consists of 1,460 for accountancy, 620 for personal financial planning advice, and 2,600 for fee in connection with the unsuccessful application for planning permission to enlarge Tony's freehold music shop. Right? Now, there are three items. One is accountancy fee, 1,460. Now, accountancy fee is something to do with the business that I am running. Therefore, that is an allowable expenditure, no adjustment required. If you don't have to adjust it, if it is allowed for both tax and accounting purposes, no adjustment is required, but the question specifically wants you to indicate it by 0. So I have to put 0. That is to show even for tax purposes, it is an allowable expenditure. Then personal financial planning advice. It's nothing to do with the business that I'm running. It's purely on a personal basis. In that case, that planning advice 620 is not an allowable expenditure. You need to add it back, 620. Then fees for planning permission. Now that is a capital type of expenditure. Fees in connection with unsuccessful application for planning permission to enlarge Tony's freehold music shop. So that is a capital type of expenditure not allowed. Therefore, 2,600 you need to add back. You need to add back. Then we will look at the next item in the calculation. We have repairs and renewals. Read note number 3. The figure for repairs and renewals consists of 270 for a replacement hard drive for the shop's computer and 400 for a new printer for this computer. Now, in this instance, you have to be careful. When it comes to repairs and renewals, if it is a replacement, you need to check whether you have replaced the whole asset. If you have replaced the whole asset, then it is actually a capital expenditure and not an allowable expenditure. You need to add it back. But if you have replaced part of an asset, if you have replaced not the whole asset but part of an asset, then it is an allowable expenditure. But if you have bought something for the first time, then it's a capital expenditure not allowed. Here, he has replaced the hard drive of the shop's computer. He hasn't replaced the whole computer, only the hard drive has been replaced. Therefore, that 270 pounds is an allowable expenditure. No adjustment is required. Allowed for both accounting and for tax purposes, no adjustment is required in such situations. Then he has bought a new printer, which is a capital expenditure. Therefore, it is not an allowable expenditure. However, this new printer qualifies for capital allowances under plant and machinery. Printer falls within the category of plant and machinery on which you can claim capital allowances, but 400 you cannot claim fully as it is a capital expenditure. Separately, under capital allowance computation, you can claim capital allowances, but 400 cost incurred is a pure capital expenditure. Therefore, it's not an allowable expenditure. You need to add back 400 pounds in this situation. Right. Then we'll look at the next item given in the question, traveling and entertaining. Traveling and entertaining. Note number 4. It says the figure for traveling and entertaining consists of 4,150 for Tony's business traveling expenses and 480 for entertaining suppliers. Now, business traveling, if it is wholly and exclusively for the purpose of business, for the purpose of trading, then it is an allowable expenditure. No adjustment is required. It's an allowable expenditure. That's why we have put 0. But entertaining suppliers, entertaining customers, entertaining suppliers, entertaining customers, they are not allowable expenditure. But if you are purely incurring cost to entertain your employees, that is an allowable expenditure. But entertaining suppliers or customers, they are not allowable expenditure. Therefore, you need to reverse it by adding it back. Then wages and salaries. Then we'll go to the next item in the income statement. We have wages and salaries. Note number 5. The figure for wages and salaries includes a salary of 16,000 pounds paid to Tony's wife. She works in the music shop as a sales assistant. The other sales assistants doing the same job are paid a salary of 12,000 per annum. It's a commonly used adjustment, but a very simple and straightforward adjustment. You can have your related parties, you can have connected parties, your relatives working for you in your business. and you can pay them a salary even, which is an allowable expenditure, but it shouldn't be too excessive. So how do you determine that? You look at the market rate, or you look at the same, you look at the salary paid to a non-related person doing the same job. So the question clearly says there's a sales assistant working for the company, for working for the business, who's paid £12,000 per annum. But to do the same job, you're paying 16,000 to your wife. So you're paying 4,000 extra to your wife because she's related to you. To do the same job, if you recruit a person from outside, you pay only 12,000. You're not permitted to claim excessive expenditure to reduce your taxable income, taxable trading profit. You can claim a reasonable amount, which is 12,000, but the excess 4,000 is not permitted. Therefore, you have to add it back. That's not permitted, add back. Then look at other expenses, note number 6. The figure for other expenses includes £75 in respect of a wedding present to an employee, 770 for Tony's Health Club subscription, and 180 for a trade subscription to the Guild of Musical Instrument Retailers. Now, 75 pounds in respect of a wedding present. Now, that is an allowable expenditure, wedding present for employee. That's an allowable expenditure because it's for the purpose of employment. If you're incurring something on behalf of your employee, it's always allowable. So that 75 pounds is an allowable expenditure, no adjustment required. You're paying your health subscription. It's nothing to do with the trade that you are running. It's a musical instrument shop. So it's nothing to do with the business that you are running. Therefore, it's not an allowable expenditure. That 770 paid to the health club is not an allowable expenditure you need to add back. But you're paying a trade subscription to the Guild of Musical Instrument Retailers. There is a club formed by musical instrument retailers. You're paying the subscription to that organization. It's something to do with the business that you're running. Therefore, an allowable expenditure, no adjustment is required. No adjustment is required. And then you have some other items given separately which are not included in the income statement. We need to look at those notes as well. Note number 7, private telephone. Tony uses his private telephone to make business calls. The total cost of the private telephone for the year ended 5th of April 2019 was 680, and 25% of this related to business telephone calls. The cost of the private telephone is not included in the statement of profit or loss expenses of 178,400. So, if you have used your private telephone for the purpose of business, the percentage attributable to the business usage is an allowable expenditure. So you can see private telephone, the total cost is 680. From that, 25% is for business purposes. So that is an allowable expenditure. That gives you 170. You can deduct 170 from your trading income because it's for the purpose of business usage. Then goods for own use. During the year ended 5th of April 2019, the owner took goods out of the music shop for his personal use without paying for them, and no entry has been made in the account to record this. The goods cost 600 and had a selling price of 950. This is what we call goods drawings in accounting. Now, in accounting, normally goods drawings are recorded at the cost value. If the owner has taken goods for his private use, normally we deduct the cost value of the goods to calculate the gross profit and the net profit. But for the purpose of taxation, remember, if the owner has taken goods for his personal use, it should be treated like normal sales. It's like an outside party has bought musical instruments from the business. It's like the business has sold musical instruments to an outsider. Therefore, for the purpose of taxation, if the owner has taken goods for his personal use, you need to consider the market value, not the cost. This has not been recorded at all in the books of accounts. Therefore, take the market value and it should be treated as normal sales. That means the trading income should increase by 950, add 950 to the tax adjusted trading profit that we are going to calculate. So add 950. Then we have an important adjustment, that is what we call capital allowance computation. I will briefly explain this capital allowance computation as it is one of the most important adjustments in the syllabus when calculating the tax adjusted trading profit. Now, as I said previously, on capital expenditure, you cannot claim the full amount as an allowable deduction. However, on plant and machinery, on plant and machinery, on plant and machinery, on plant and machinery, we can claim capital allowances. There are different ways that you can claim capital allowances. There are different approaches you can take. It depends on the nature of the plant and machinery. So there is something called annual investment allowance. There is something called annual investment allowance. There is something called first year allowance. There is something called written down allowance. And the written down allowance is based on whether it's a main pool plant and machinery or special rate pool plant and machinery. So accordingly, you can claim capital allowances in different ways. So if you take annual investment allowance, during a tax year, if you have bought new plant and machinery up to a limit of 200,000 pounds, if you have prepared accounts for a period of 12 months, up to a limit of 200,000 pounds, you can claim annual investment allowance or AIA. But remember, you are not permitted to claim annual allowance on motor cars. Other than motor cars, on any other plant and machinery, including vans, you can claim annual investment allowance up to 200,000 pounds. If the period of account is lesser than 12 months, you need to time apportion this 200,000. Likewise, if the period of account is more than 12 months, again you need to time apportion the annual investment allowance. So that's how you have to do the computation. Then first year allowance is given only on new low emission motor cars. If the carbon dioxide emission of the vehicle is 50 grams per kilometer or less, if the carbon dioxide emission of the vehicle is 50 grams per kilometer or less, in that case, up to 100% of the cost you can claim as first year allowance. It doesn't matter whether the period of account is 12 months, less than 12 months, or more than 12 months. The 100% cost incurred to buy the new low emission car can be claimed fully as first year allowance. Now, for that, it has to be a low emission car where the carbon dioxide emission is limited to 50 grams per kilometer or less, and it has to be a new low emission car as well. So if it is a used one, you cannot claim first year allowance. All the other plant and machinery, except for plant and machinery, which are normally included in the special rate pool, must be included in the main pool. There is something called special rate pool plant and machinery, such as high emission motor cars. That is, the carbon dioxide emission of the car is more than 110 grams per kilometer, 110 grams per kilometer, then we call it a high emission motor car. If it is a high emission motor car, it must be included in the special rate pool. And there is something called long life assets, where the lifespan of the asset is more than 25 years and the cost incurred exceeds £100,000. We call them long life assets. They are also included in the special rate pool. In addition to that, the integral features of a building. You know, on building, you cannot claim capital allowances. They are not considered as plant and machinery for this purpose. However, the integral features of a building, such as uh, an elevator, uh, uh, elevator. In addition to that, if you have a central AC system, thermal insulation system, water heating system, air purification system, if you have integral features like this in a building, which can be separated from the building like an escalator, an elevator, then you must include this plant and machinery in the special rate pool. The disadvantage of including plant and machinery in the special rate pool is that the maximum capital allowance, the maximum written down allowance you can claim is limited to 8%. All the other plant and machinery can be included in the main pool and you can claim 18%. However, if the period of account is less than 12 months or more than 12 months, you must time apportion this 18% or 8% if they are included in the special rate pool. Then we have something called small pool WDA. I'm giving you a summary for this capital allowance computation. We have something called small pool WDA. That is a situation where the main pool balance or the special rate pool balance for a period of account of 12 months is limited to £1,000 or less. If the main pool or special rate pool balance becomes £1,000 or less, then you don't have to claim 18% or 8%. Instead, you can claim the full amount. Say the main pool balance is £900. It's less than £1,000. Then the full £900 without claiming 18%, the full £900 you can claim as small pool WDA because the pool has become small. The pool balance is £1,000 or less. The pool has become small. In that case, without claiming 18 or 8%, the full amount can be claimed as small pool WDA. Then we have something called short life assets. Short life assets are assets which we have purchased with the intention of reselling within a period of 8 years. If it is a short life asset, without including that asset in the main pool, we can maintain a separate column for that short life asset, and whatever the balancing allowance you get at the time of disposal can be claimed fully as capital allowances. Then, a very important thing with regard to unincorporated businesses such as sole proprietorships and partnerships, that is, if the owner uses an asset for his private purposes, not an employee, but the owner uses an asset for his private purposes, you cannot include that asset in the main pool or in the special rate pool. You need to maintain a separate column. Say a car is used by the owner 80% for business purposes, 20% for private purposes. In that case, when you're claiming capital allowances, you cannot claim 100% capital allowances on that because there is an element of private use which is 20% in my example. Hence, you can claim capital allowances only up to 80%. For you to calculate that 80% capital allowance figure, you need to always maintain a separate column for private use asset by the owner. If an employee uses an asset for private purposes, still you can claim 100% capital allowances. Now we will look at the question that we have been given. It's a simple and straightforward situation. Plant and machinery, note number 9, the tax written down values for capital allowance purposes at 6th of April 2000, 2018 were in the main pool 7,400, and car with private use car is there, so you need to maintain a separate column for that by the owner. Private use by the owner. Carbon dioxide emission is 106. If the carbon dioxide emission, now when it comes to motor cars, remember, if it is a new low emission car where the carbon dioxide emission is 50 grams per kilometer or less, then you can claim first year allowance. If it is a low emission used car, then it's included in the main pool. Even though it's a low emission car, if it is a used one, you include it in the main pool, and later you can claim WDA at 18%. But if it is a high emission car where the carbon dioxide emission is more than 110 grams per kilometer, then it's included only in the special rate pool. If the carbon dioxide emission is between 51 to 110 grams per kilometer, then it's included in the main pool. So here, it's a car with a carbon dioxide emission of 106 grams per kilometer. It is a car that should have been included in the main pool where I was permitted to claim WD at 18%. But since there is a private use element by the owner, I cannot include it in the main pool. I need to maintain a separate column. I can claim 18%, but I need to limit it to the business use. The car was used by Tony. It was sold during the year for £11,000. A new car also used by Tony was bought for £25,000. It has carbon dioxide emission of 159 grams per kilometer. Now that's a high emission car. Then normally it's an item included in the special rate pool. But since there is a private use element by the owner, we cannot include it in the special rate pool. We need to open up a new column for this private use car, which is a high emission car, on which we can claim only 8%. Okay, now we will look at the capital allowance computation, a simple and a straightforward one. So this is how you do the computation. The main pool has a balance of opening balance of 7,400. Private use car, the old one, that's why we call it car one, has a opening tax written down balance of tax written down value balance of 16,200. Then during the year, we have made one purchase, that is this new car, which is a high emission car where the carbon dioxide emission is more than 110 grams per kilometer, normally included in the special rate pool, but it is used by Tony for his private purposes. Therefore, without including it in the special rate pool, maintain a separate private use car column for that, which is £25,000. Then during the year, we have, don't forget, we have bought another plant and machinery. If you look at repairs and renewals, note number 3, in that I explained we have bought a printer. Printer is a capital expenditure. We could not claim 400 as an allowable expenditure. We had to add it back. But printer falls within the category of plant and machinery, on which we can claim something called AIA. On the printer, we can claim AIA up to £200,000, but here we have only £400, so the full amount can be claimed as AIA, annual investment allowance here. So under capital allowances, this 400 you can claim AIA capital allowances. So you can see these are things you can omit to take into consideration. So to make a note of these things, because easily you can omit to record this £400 on which you could have claimed AIA, right? Then there is a disposal. The old car we have sold for how much? £11,000. So if it is a disposal, you have to always take the lower of the cost or the selling price. So of course, the tax written down value still is 16,200 and you have sold it for 11,000. Therefore, the selling price has to be lower than the cost. So when it comes to a disposal, always remember you have to take the lower of. You have to take the lower of cost or the selling price. So here it's a selling price 11,000. When you deduct it, you get a difference of 5,200. You get a difference of 5,200. Now this 5,200 I can claim fully as capital allowances because the asset is no longer there for me to carry forward any balance. Whatever the balance I have, I can claim fully as capital allowances because the asset is no longer there in the business. This is what we call balancing allowance. The full amount you can claim as balancing allowance, but do not forget, this is a private use car by the owner. Normally, the full amount could have been claimed as balancing allowance. But in this instance, this car was used by Tony for his private purposes. Again, you have to be careful here because the private use percentage is not given, but we have previously calculated this figure under business mileage. Can you remember we did a computation? This car was used by Tony for his private purposes. It was used by Tony for his private purposes. Now, this was the calculation that we previously did. He did 20,000 miles from this car. He did 20,000 miles from this car. From that, 6,000 for private use, 14,000 for business use. So the private use percentage was 30%. The business use percentage was 70%. So that means from the balancing allowance figure, we can only calculate, we can only claim 70%. We can only claim 70% as balancing allowance or capital allowances. So you can see this is very important. So we can claim only 70% here, 70% of the balancing allowance as capital allowances, which is 3,640. Then on the main pool, there is a balance of 7,400. I can claim WD at 18%, which is 1,332. The full amount can be claimed as capital allowances. And finally, there's a new motor car that I have bought for my private purposes as well, which will be used 30% again for private use, 70% for business use as mentioned in the question. But don't forget that this is a high emission car. This is a high emission car. Therefore, the WDA that I can claim is not 18%, it's only 8%. Hence, on the value of this car, 25,000 pounds, I can claim only 8%, which is 2,000. But again, don't forget, I cannot claim the full amount, 2,000 pounds, as the car is used 70% for business purpose and 30% for private use. Only 70% I can claim as capital allowances. So this is how you deal with private use of an asset by the owner. This is only relevant when you're doing the computation for an unincorporated business. For a company, there's nothing called private use adjustment. Anyway, 400 we claimed fully as AIA, and then 1,332 as WDA, and here 3,640 and 1,400 as WDA 18% and 8%, but both had some kind of a private use of 30%. Therefore, we were able to claim only 70%. So in total, we can claim a full amount of 6,772 as capital allowances. So finally, 6,772 I can deduct as capital allowances. I get a tax adjusted trading profit of 177,888. So these are the commonly tested adjustments at the exam with regard to employment income and self-employment income, the most important areas in your individual income tax computation. So now we'll take a break for 10 to 15 minutes. Once I come back, I will do some questions from trading loss relief and corp tax computation. So we'll take a short break for 10 to 15 minutes and we'll be back um, at around 4:15. So be with us, and after the break, I'll be discussing corp tax and trading loss relief question. Thank you very much. Okay, guys, we can start again. Now, as I said, we can do a few questions from trading loss relief as well, another highly examinable area in your syllabus. And for that, I have decided to discuss question number 5 with you. Simon, that question number 5, trading loss relief. Now, when it comes to trading loss relief, there are several reliefs available for an individual. For an individual who's running an unincorporated business, there are several reliefs available. One is carry forward relief. Now, when it comes to carry forward relief, there are any trading loss you can carry forward to set off against future available trading profit from the same business. Then there is something called relief against total income of the current year and or the previous year. So if you have a trading loss, another option that you have is the trading loss can be set off against the current year total income and or the previous year. That means carrying back 12 months. Then the other relief available is opening year relief. Now this before that, I'm sorry, the third one, relief against capital gains of the current year and or the previous year. Relief against the capital gains of the current year and or the previous year. When you say capital gains here, when you say capital gains, the capital gains after deducting both current year and carry forward losses, there is a remainder. Against that figure, you can set off your trading losses. Then we have something called opening year loss relief, which is applicable to newly started businesses. In that situation, any trading loss incurred within the first 4 tax years of the business, if it is a newly started business, if you have incurred a trading loss within the first 4 tax years of the business, you can carry back that loss for a period of 36 months to set off against the total income according to first in, first out basis. That is what we call the opening year relief. Then we have something called terminal loss relief, where it is applicable only in situations you cease trading. If you wind up the business, if you close down the business, then you can't carry forward your trading losses anymore. You wind up the business. You can't carry forward, the business comes to an end. So carry forward relief would not be available. In such situation, this special terminal loss relief is there. In that situation, if the business has incurred a trading loss during its last 12 months trading, if the business has incurred a trading loss, that can be carried back for a period of 3 years. To set off against trading profits only, not against total income, but only against trading profits according to last in first out basis. So we'll look at the answer for question number 5. Simon began trading on the 1st of January 2016. So this is a newly started business then. So that is very important. Began trading on the 1st of January 2016. Prepare accounts to 31st December annually with results as follows. Year ended 31st December 2016. There's a loss of 12,000. Year ended 31st December 2017. Another loss of 4,000. Year ended 31st December 2018. A profit of 9,000. An estimated profit of 11,500 for the year ended 31st December 2019. Details of the amounts of other income for the tax year 12-13 to 15-16. That is for the previous tax years. This person has a salary from employment from 12-13 to 15-16 tax years. And then he also has bank interest from the tax years starting from 12-13 ending 15-16. From 1st of January 2016, the business is Simon's only source of income. That's the date he started the business. So after that, no employment income and no bank interest income as well. Simon wishes to obtain relief for his initial trading losses highlight as soon as possible. So we have to use the loss relief according to the requirements of the question. So we need to get the relief as quickly as possible. But before dealing with the loss relief here, we have to deal with another important concept in taxation, which is known as basis of assessment rules. You cannot answer this question if you are not familiar with the basis of assessment rules, because basis of assessment rules helps you to identify the trading loss or the trading profit relevant to each and every tax year. Without knowing the basis of assessment rules, you can't even think of attempting this question. You can't attempt this question without knowing the basis of assessment rules. It's not possible. Therefore, basis of assessment rules and trading losses most of the time go hand in hand. Now, what do you mean by basis of assessment rules? These rules are only applicable to individuals who are running unincorporated businesses. For companies, basis of assessment rules are not applicable. Now, here, basis of assessment rules are there to nullify any discrepancies or to make compatible the accounting period and the tax year. There can be situations most of the time where the accounting period is different from the tax year that you are in. So if the tax year and the accounting periods are different from each other, to make them compatible, we are using something called basis of assessment rules. For an ongoing business, we use something called current year basis. There, what we have to look at is whether there is a period of account ending in the tax year, and then if that period of account is for 12 months, the whole profit must be taxed in the relevant tax year. But if it is a newly started business, we have something called opening year rules. We have something called opening year rules. Now, how do we apply these opening year rules? The very first thing that you have to do here, is that identify your very first tax year. Identify your very first tax year. How do you identify your first tax year? How do you identify your first tax year? For that purpose, you need to look at the date of commencement of trading. When you do start trading? 1st of January 2016. 1st of January 2016, you started the business. So the date of commencement falls into which tax year? 2015-16. The very first thing that you should do is that identify the first tax year of the business by looking at the date of commencement. In this example, it is 1st January 2016, and that falls into 2015-16 tax year. So your first tax year of the business is going to be 15-16 tax year. For the first tax year, the basis that you have to use, you call it the actual basis. You call it the actual basis. You use the actual basis. What do you mean by the actual basis? Identify the loss or profit from the date of commencement to the last date of the tax year. From the date of commencement to the last date of that tax year. So here you cover a period of 3 months. Now go back to the question. Year ended 31st December 2016. For a period of 12 months, there is a loss of £12,000 for the first tax year. Under actual basis, we have to consider only 3 months of the loss. Only 3 months of the loss. So from 12,000, which is for a period of 12 months, under the actual basis for the tax year, we need to consider only 3 months profit or loss. So take 3 months loss here, which is £3,000. Which is £3,000. So this is the loss attributable to the first tax year. So that is how you apply the opening year rules for the first tax year. You identify the first tax year by looking at the date of commencement, and then you identify the actual time period from the date of commencement to the last date of the tax year, and you time apportion the loss or profit for the first tax year. Then the second tax year. So the second tax year has to be 2016-17. You need to ask an important question here. You need to ask an important question here. That is there a period of account ending in the tax year? The first question, is there a period of account ending in the tax year? Ending in the tax year. So 16-17 tax year starts on the 6th of April 2016. 16th of April, 6th of April 16 to 5th of April 17. This is the 16-17 tax year. Your first period of account started on the 1st of January 16, and you prepared accounts up to 31st December 16. So your first period of account is 12 months and ending on the 31st December 2016. So your first tax year is ending, first period of account is ending during the tax year 2016-17. So yes, there is a period of account ending in the tax year 16-17. My first question is what? Is there a period of account ending in the tax year 2016-17? Yes. Year ended 31st December 2016 falls into 16-17 tax year. Then the next question that I have to ask, if the answer is yes, there is a period of account ending. Ending means you look at the last date of your accounting period. Your last date of your period of account in this example is 31st December 2016. 31st December 2016 is a date which falls into 16-17 tax year. So you look at the period of account ending date only, and that date falls into the current tax year 16-17. So there is a period of account ending in the tax year. The answer is yes. Then you ask the second question, how long is the period of account? How long is the period of account? There are three possible answers here. One, it can be 12 months. It can be more than 12 months. It can be less than 12 months. These rules, you don't have any other choice. You have to memorize it and accordingly apply it. Yes, there is a period of account ending in the tax year. And how long is the period of account? 12 months. That's why we call it year ended. 12 months. If it is 12 months, you must apply current year basis. That means the whole profit from 1st of January 16 to 31st December 2016, the whole profit must be taxed in 16-17. If there is a loss, the whole loss must be taken into account. If there is a profit, that might result in something called overlap profit. Overlap profit is a situation where the same profit has been taxed previously in a different tax year. In the last tax year also, part of the profit has been taxed, and now the same profit is taxed again due to current year basis rule that we apply. We call it overlap profit. That's unavoidable. But the important thing that you need to remember is there's nothing called overlap losses. There is something called overlap profits, but there's nothing called overlap losses. So if you have already taken a particular loss for the previous period, even though you're going to loss is 12,000, you have to take it, but for the previous year, out of that 12,000, 3,000 already used in 15-16. Already used in 15-16. Therefore, only the balance 12,000, balance 9,000 you have to take into account. So when you do like this, it will not result in any overlap losses. So first tax year, there's a loss of 3,000. Second year, balance loss of 9,000. For completeness, for the basis of assessment rules, remember, if there is a period of account ending in the tax year, And if the accounting period is more than 12 months, if the accounting period is more than 12 months, you have to take last 12 months profit as taxable profit. If it is less than 12 months, you have to take first 12 months profit as your taxable profit. Now, these you have to memorize. If there is no period of account ending, if the answer is no here, if the answer is no here, in that case, you again take the actual basis, take the profit or loss from 6th of April to 5th of April following tax year. So basis of assessment rules a must. You have to memorize the rules and then you have to have the ability to apply them. So here I have applied the opening year rules and accordingly trading losses, the trading loss of 12,000 is now split into two separate tax years, 3,000 to the first tax year and 9,000 to the balance tax year. Okay. Let me erase this part. Then you have to use the normal method for the balance. Again, you ask the same two questions. For the other two tax years also, you apply the same, you ask the same two questions. One is check whether there is a period of account ending in the tax year and check how long is the period of account. How long is the period of account? So here 2017-18, you check whether there's a period of account ending. Look at the question. Yes, year ended 31st December 2017. Last date of the accounting period falls into 17-18 and the whole loss 4,000 should be taxed in 17-18. Then 18-19 tax year. Is there a period of account ending in the tax year 18-19? According to the information given, 31st December 2018 falls into 18-19 tax year. There it's not a profit, it's a loss of, sorry, it's not a loss, it's a profit of 9,000 pounds. It's a profit of 9,000 pounds. So just leave it like that. And then there's an estimated profit for the year ended 31st December 2019 that falls into 1920 tax year. Year ended 31st December 2019 is a date, falls into 1920 tax year, and the period of account is 12 months. So you use the current year basis. So we expect a profit of 11,500. Now you would notice that you have incurred 3 losses during the first 4 tax years. Now, the question warns you, calculate the trading income assessment for the tax year 15-16 to 19-20, assuming all losses are carried forward. All losses are carried forward. So the first question warns you to consider only the carry forward relief. Only the carry forward relief. Now, what is carry forward relief? If the business has incurred a trading loss, it can be carried forward to set off only against the future available trading profits in the maximum possible way. You have a trading loss this year, you carry forward and you can set it off against the first available trading profits of the same trade, not against any other trade. From the same trade profit you can set it off. When you carry forward for an unincorporated business, when you carry forward for an individual, trading losses cannot be set off against any other income. It can only be set off against another trading profit of the same business. So here 15-16, 16-17, 17-18 Continuously, you have been incurring losses in total 16,000. According to part A, you are supposed to use the carry forward relief. So this 16,000 you can carry forward and set off against the first available trading profit. So 1819, for the first time, you get a trading profit of 9,000. So from this 16,000, the maximum possible amount, which is maximum possible amount, that is out of this 16,000, maximum possible amount you have to set off is 9,000. So out of this 16,000 accumulated loss, you can set off 9,000. Then this is how you can use the carry forward relief. There's no trading profit 18.9 for the tax year 18-19 after the carry forward relief. From 16,000, you utilized 9,000 pounds. From 16,000 loss, you use 9,000 pounds against trading profit. Here you can't decide how much you're going to use. The maximum possible amount must be set off against the first available trading profit. It's an automatic relief. You can't ignore it. It's a must when you go for the carry forward relief. If there is a trading profit, maximum possible amount you must set off. Maximum possible amount you must set off in a situation like this. Okay, then still you have a balance of 7,000 out of 16,000. That 7,000 you must set off against the next available trading profit. So here you can see balance 7,000 you have set off here. So likewise, if you go for the carry forward relief, you can use 9,000 in the tax year 18-19, balance 7,000 you can use it in 19-20 against 11,500. So that is how you can use the carry forward relief. So there will be a balance of trading profit in the tax year 19-20, 4,500. Then question number 2. Explain and show the loss incurred in the first 2 calendar years of trading are to be relieved so as to provide relief as early as possible. Now the second requirement is different. First one wanted us to use the carry forward relief. But the second question wants us to use an alternative relief, which is known as the opening year relief. I explained the opening year relief previously as well. Opening year relief means if the business has incurred a loss during the first 4 tax years of the business. During the first 4 tax years of the business, if the business has incurred a trading loss, that loss can be carried back for a period of 3 years or 36 months to set off against what? Set off against total income according to first in, first out basis. You can, if you have incurred a loss during the first 4 tax years, that's a rule. Those first 4 tax years losses can be carried back 36 months or 3 years to set off against total income according to first in, first out basis. In this question, they want us to consider only the losses incurred during the first 4 tax years. Sorry, first 2 tax years. Explain and show how the losses incurred in the first 2 calendar years of trading are to be relieved. So first 2 calendar years are 31st December 16, 31st December 2017. But these 2 losses fall into 3 separate tax years. We did that computation. Accordingly, First tax year, there was a loss of 3,000. Second tax year, 9,000. And then third tax year, there's a loss of 4,000. For these losses, we can actually use the opening year relief. So how does it work? So here, 2015-16 loss is 3,000. This loss we can carry back 3 tax years. That means you can go back to, from 15-16, you go back 3 tax years. You go back 3 tax years. So there you have 2014-15, 2013-14, and 2012-13. So this 3,000 you can carry back for a period of 3 tax years to set off against total income according to first in first out basis. That means you can set it off first against 12-13 total income, then against 13-14 total income, and finally against 14-15 total income. That is how the opening year relief. So we can see that how they have done it. £15-16 loss of £3,000. 15-16 loss of £3,000. Claim against total income for 15-16 and of 14-15. Now, that is not the opening year relief. That is a normal relief available. What is that? For an ongoing business, in addition to the carry forward relief, you have a relief called relief against total income of the current year and or the previous year. That is what we call relief against total income of the current year, very important, and or the previous year. Now the loss making year is 15-16. So the current year is 15-16. Previous year is 2014-15. So if you have a loss, you can set it off against the current year and or the previous year total income, against total income that I have mentioned, against total income. And very important, and or. So when you're setting off your trading losses, remember, you have the preference, you have the flexibility to determine this 15-16 loss. If you want, you can first 15-16 loss, you can first set it off against 15-16 total income, then against 14-15 total income. That's one option. Another option is trading loss of 15-16. You can first set it off against the previous year, then against the current year, or else only against the current year, not against the previous year, or else use it only against the previous year, don't use it against the current year, or else neither the current year nor the previous year. So this is what we call relief against total income of the current year and or the previous year. This relief is applicable to any ongoing business. But if it is a newly started business, in that case, you have a special opening year relief. You can carry back your trading losses for a period of 3 tax years, as I explained previously, and here, this is what I mentioned. Opening year loss relief You carry back 3 years, first in, first out basis, 12, 13, 13, 14, and 14, 15 in that order. So I mentioned this previously above. So you have to use the first in, first out basis. So this gives you the opportunity to relieve your losses at the earliest, excuse me, at the earliest opportunity, as early as possible. Actually, this would result in cash refunds as well. For these old tax years, you have already paid taxes. But when you use the opening year relief, it indicates that you have paid more taxes than you are required to pay. Therefore, you can expect cash refunds. For the purpose of cash flows, this is beneficial for the individual. Then 16, 17 also, there is a loss of £9,000. There's a loss of £9,000. Sorry. So 16, 17, £9,000. You can carry back 3 tax years, starting from the earliest year first. Starting from the earliest year first. So if you do that, you can first set it off against 13, 14 total income, 14, 15 total income, and finally 15, 16 total income according to first in, first out basis. This is the special opening year relief, 13, 14, 13, 14. You can see that. And then 14, 15, and finally 15, 16. If you are not going for the opening year relief, you can use the normal current year and or the previous year relief. In that case, you can use either 16, 17 and or 15, 16. So this is how you deal with the opening year relief. This is how you deal with that's how you're supposed to deal with the opening year relief. So anyway, this is a special relief that has been tested few times at the exam. Then we're running out of time. However, I will explain question number 7 as well, because that explains the terminal loss relief. That explains terminal loss relief. So we will look at that question number 7 actually. Look at question number 7. Mr. Tapp ceased trading as a sole trader on 31st March 2019. So you can, by the way, if you go back to the previous question, it explains how the loss has been relieved in this computation. So you can see this is a relief against total income. So 12, 13, they have taken the total income. So the salary, interest, everything you have to take into consideration. So remember, when it comes to the opening year relief or relief against total income, you have the privilege of setting off your trading losses against the total income, not just limited to trading profit. So it's a special relief available. So you can consider any income, including salary, property, savings income, dividend income, anything. So the trading loss you carry back for 3 tax years and set it off against the total income in those tax years. So anyway, that's how the opening year relief works. Now let me explain the terminal loss relief here. Terminal loss relief. So we'll read question number 7, Mr. Tapp. He ceased trading as a sole trader on 31st March 2019. He's now the managing director of ACCA Limited, and he's paid a salary of 20,500 per annum. The tax-adjusted trading profit and loss of the business up to cessation have been: year to 31st March 2016, 8,000; year to 31st March 2017, 12,750; year to 31st March 2018, 10,500; year to 31st March 2019, 7,000 a loss. There are unrelieved overlap profits of 3,700. When I was doing the previous question, I explained the meaning of the concept overlap profits. In January 2019, Mr. Tapp sold a residential buy-to-let property which he had inherited on the death of his grandfather in March 2014. The chargeable gain on the property was 60,200. He had been unable to find a tenant for the property and had therefore received no rental income. Mr. Tapp's only other source of income is bank interest of 2,300 each year. Explain the implications of Mr. Tapp making a terminal loss claim. You are not required to produce detailed calculations. Okay. What do you mean by terminal loss relief? If you have ceased trading, if you are going to wind up the business within the last 12 months of trading, if you have incurred a trading loss, that trading loss can be set off first against the trading profit of the last tax year. Any unrelieved amount can be carried back for 3 tax years to set off only against the trading profit according to last in first out basis. That is what we called the terminal loss relief. This special relief is available as we are no longer permitted to use or claim the carry forward relief. Why? We are winding up the business. We cease trading. Therefore, if you have incurred a loss, if you have incurred a loss during the last 12 months of trading, of the business, that loss, first of all, we should try to set it off against the same tax year's trading profit. Highly unlikely because you already have a loss during the last 12 months. But if you have a trading profit, first set it off against the trading profit of the current year and then carry back 36 months, 3 years to set off against trading profits only. Now, when you carry back, unlike the opening year relief, under the opening year relief, we were able to set it off against total income. But under terminal loss relief for an individual, when we carry back, we can only set it off against trading profits. And one important thing, under opening year relief, we were permitted to set it off against total income, plus we use first in, first out basis. But under terminal loss relief, when we carry back for 36 months or 3 years, we can only set it off against trading profit and using last in, first out basis. So these differences you need to remember properly. However, the very important thing here that we need to do is we need to find out the loss for the last 12 months of trading, last 12 months trading loss. Now, here, if you look at the accounting periods and the tax years basically are the same. 1st of April, 31st March, and 6th of April to 5th of April, we can take them as similar periods of accounts for this calculation purposes. So if you look at, now, when is the date of cessation? Date of cessation, according to this question, date of cessation, according to this question, is 31st March 2019. You cease trading on the 31st March 2019. This is the date of cessation. You need to find out the loss incurred during the last 12 months. that is starting from the 1st of April 2018. For the year ended 31st March 2019, during the last 12 months, we have incurred a loss of £7,000. But don't forget, if you have incurred an overlap profit, you can add that amount to the trading loss incurred already. Therefore, your terminal loss in this instance is £10,700. Overlap profit is a profit which we have paid taxes twice. So overlap profit is 3,700, which indicates on 3,700 we have paid taxes twice in two separate tax years. We have paid taxes twice on this 3,700. Therefore, you have a special relief available under terminal loss relief. If there's any overlap profit on which you have paid taxes twice, that overlap profit can be added to the loss, and on the total you can claim a terminal loss relief. Therefore, the total loss that you have is 10,700. This is what we call the terminal loss here. Okay. So this terminal loss 10,700, what can we do with it? We need to find out the trading profit for the last few tax years. Now, again, we have to apply the basis of assessment rules. Here we don't have a problem actually, because our period of account and the tax years are the same. Otherwise, we have to apply the closing year rules. Under closing year rules, first you have to identify your last tax year. Under closing year rules, you need to find out the last tax year. Closing year rules. Identify the last tax year. How do you identify the last tax year? We look at the date of cessation. The date of cessation falls into 2018-19 tax year. That means for my business, my last tax year is 18-19. Then I identify the penultimate year. We call that is the tax year one before last, penultimate year. I identify my last tax year by looking at the date of cessation, which is 2018-19 in this situation. And then I take 1 year before last. We call it the penultimate year. For the penultimate year, you use the current year basis. That means, look at the question. In the question, I have been given amounts for the year ended 31st March 2016. Year ended 31st March 2017. Year ended 31st March 2018. Year ended 31st March 2019. So for 17-18, the penultimate year, I must use the current year basis. Accordingly, from these year ending dates, which date falls into 17-18? You would clearly see year ended 31st March 2018. Year ended 31st March 2018, that profit is how much? 10,500 falls into 17-18 tax year. When you do that, if there's any profit that has not been taxed in the last tax year, that profit must be taxed in 18-19. But in this instance, for 18-19, we don't have a profit. We have a loss of 7,000, and now we have a terminal loss of 10,700 with the overlap profit. So what we can do is this terminal loss, first I must set it off against 18-19 trading profit, but I don't have it. Otherwise, I can carry back and set it off against last 3 tax years trading profit according to first in, first out, according to last in, first out basis. So that means I have 10,700. The loss can be offset against the trading income of the tax year 18-19, the final year, and the 3 preceding tax years. 3 preceding tax years on a last in, first out basis. He has no trading income in the last tax year, 2018-19. So the terminal loss claim will relieve all of the trading income, 10,500 in the tax year 17-18. So if I explain the computation here, so there's a loss of 10,700. There's a loss of 10,700. So what I should do here is this terminal loss I can carry back 3 tax years. So terminal loss first against current year, that is 2018-19. Then carry back 3 tax years according to last in, first out basis. That means 17-18, 16-17, and 2015-16. Last in, first out basis. So this is the order. 17-18, against what we can set off the terminal loss? Against trading profit. 17-18, look at the question. There's a trading profit of 10,500. And then for 16-17, there's a trading profit of 12,750. And year ended 31st March 2016, there's a trading profit of 8,000. So how much is your terminal loss? Your terminal loss is 10,700. From that 10,700, terminal loss, you have a trading loss of 10,700. From that, you carry back and set off 10,500 against this 17-18, and another 200 against 16-17 according to last in, first out basis. We don't have to use 15-16. The full terminal loss 10,700 will be relieved in this particular way. So that is what you get here. So the terminal loss claim will relieve all of the trading income, 10,500 in the tax year 17-18, 200 from 16-17. Then Part B says, briefly explain the other reliefs available to Mr. Tapp in respect of the loss made in the year ended 31st March 2019. You are not required to produce detailed calculations. And Part C, explain the reason the relief which Mr. Tapp should claim in respect of the loss for the year ended 31st March 2019. Okay. Now, that is a complete question from all the reliefs available. But since we are going to cease trading, you must remember carry forward relief is not available. Carry forward relief is not available. So one relief available here is terminal loss relief, as I explained previously. Terminal loss relief. So this is how we apply the terminal loss relief. The other situation is this trading loss can be set off against the total income of the current year and or the previous year. The question says in January 2019, Mr. Tapp sold a residential buy-to-let property which he had inherited on the death of his grandfather in March 2014. The chargeable gain on the property was 60,200. He had been unable to find a tenant for the property and had therefore received no rental income. Mr. Tapp's only other source of income is bank interest 2,300 each year. Okay, so this is terminal loss relief. Now, if you use the terminal loss relief, 1718 against this 10,500, you can set off 10,500 of the terminal loss. Now, other than this trading profit, Mr. Tapp has only one other income, that is 2,300 savings income. 2,300 savings income. Now, if I use the terminal loss relief, you will see for the tax year 17-18, I don't have a trading profit if I use the terminal loss relief. If I use the terminal loss relief, I can set off 10,500 against my trading profit. Therefore, my trading profit for the tax year 17-18 becomes 0, and I only have 2,300. But that is not going to be anyway an issue, because everything will be covered by the personal allowance, because I have 11,850 as a personal allowance. Therefore, most of my total income will be covered by the personal allowance. Now, that is what they are trying to explain here. In the tax year 17-18, the tax saving will be 0, as Mr. Tapp's taxable savings income falls within the starting band for savings income and is therefore subject to income tax at 0%, and his trading income is covered by the personal allowance. Tax saved in the tax year 17 will be the basic rate of 20%. Now, what do you mean by that? Earlier today, at the very beginning, we learned if your savings income falls within the first 5,000 of your taxable income, that savings income will be taxed at 0%. So on this 2,300, anyway, you don't have to pay taxes. That is because it is covered by that special rate. It's like this. Let me explain it here. Now it's like this. Forget, okay, for 2017-18, forget about the terminal loss. Then you have a total income of 10,500 plus 2,300. Non-savings income is 10,500 pounds. Savings income is 2,300 pounds. So 12,800. 10,500, 2,300. Then you have the personal allowance of 11,850. So 10,500. And then here you have 1,350. The balance you can set it off here. Then you get 0. And here you get, sorry, 950. 950. So you have only a taxable income of 950, even though you don't claim the terminal loss relief. Assume you're not claiming the terminal loss relief. If you don't claim the terminal loss relief even, you will still be having a taxable income of 950 after claiming the personal allowance. And that 950 will be savings income. It will be savings income. Even this savings income 950 will not be taxed, as this will be subject to 0%. This will be subject to 0%. Why? If your savings income falls within the first 5,000 of your taxable income, then the applicable rate is 0%. So even though you don't have the terminal loss relief, for the tax year 17-18, you don't have to pay taxes. Even though you don't claim the terminal loss relief for the tax year 17-18, you don't have to pay any taxes. That means terminal loss relief didn't give you any unusual benefit. Even though you do not claim the terminal loss relief for the tax year 17-18, there won't be any taxable income to be taxed. You have a taxable income of 950, but that consists of savings income which will fall within the first 5,000 of taxable income. Therefore it won't be taxed. Anyway, for 17-18, you don't have to pay taxes, notwithstanding whether you claim the terminal loss relief or not. Therefore, this terminal loss relief does not give you any special benefit. It doesn't give you any special benefit. Then what we should do? Okay, so terminal loss relief doesn't give us any benefit. That is why in this question, in the answer, they say in the tax year 17-18, the tax saving will be 0, as Mr. Tapp's taxable savings income fall within the starting band, that is 5,000 income, and therefore subject to income tax at 0%. And his trading income is fully covered by the personal allowance. We saw that his taxable income, his trading income, this is 10,500. It was fully covered by what? It was fully covered by the personal allowance. So it didn't give us a benefit. Now we will look at 2016-17. 2016-17. These are time-consuming explanations, but very important for the exam for you to understand it. So here, if you look at 2016-17, if you look at 2016-17, there you have 12,750. That's the trading income. Then you have savings income of 2,300. So non-savings income 12,750. Savings income 2,300. So you have 15,000. 15,050, out of which 12,750 is non-savings income, balance 2,300 is savings income. Here, if you claim your personal allowance, 11,850, still there is a taxable income. Taxable income for trading profits. So here you have 3,200. Here 900. So this 2,300 will be taxed at 0 rate, as it falls within the first 5,000 of your taxable income. First 5,000 of your taxable income, it will be at 0 rate, but on this 900 you have to pay taxes at 20%. Therefore, if you use the terminal loss relief, then we get the opportunity to reduce our taxable income. We get the opportunity to reduce our taxable income by £200. If you don't claim the terminal loss relief, you will be having a trading income of 900, which will be taxed at 20%. But if you claim the terminal loss relief, then this 900 will be reduced by 200, and therefore you can have a tax saving of 20%. So 1718 does not give you any tax saving because it's fully covered by the personal allowance. But for 1617, we can get a tax saving at 20% only on this £200 because it's not fully covered by the personal allowance. So we should have the ability to analyze like this. So that's actually for part A. But what are the other reliefs that are available? What are the other reliefs available? So you can see a trading loss can be offset against total income of the tax year of loss and or the preceding year. This is in all or nothing basis. If there are sufficient losses, will reduce the total income to 0. Accordingly, the loss in the tax year 1819, 10,700 can be offset against total income 1819 and 1718. A further claim is available which enables sum of all the trading loss to be converted into capital loss. Okay, I'll explain it like this. So according to this question, there's a trading loss. What we can do is that trading loss, we can set it off against the current tax year and or the previous year. So the trading loss is relevant to which tax year? Look at the question. It is relevant for the tax year 2018-19. The loss was for the tax year 2018-19. 2018-19. So that is the current year. So if we want, we can set off this trading loss against the current year and or the previous year, 17-18. 17, 18 against what? Total income. That is one situation. Calculations are not required here. You just have to explain it. But there is another special relief available other than the total income. You can treat your trading loss as a capital loss, and it can be set off against your chargeable gains as well. Chargeable gains of the current year and or the previous year. Question says in January 2019. January 2019 falls into which tax year? January 2019 falls into 18-19 tax year. 18-19 tax year, according to the question, we have a chargeable gain of 60,200. We have 60,200. So if we want, the loss can be set off against, our trading loss can be set off against this chargeable gain 60,200. Effectively, we are treating our trading loss as a capital loss and setting it off against the chargeable gain. But a very important thing to remember is that there is a prerequisite. What is the prerequisite? You cannot set off a trading loss at once against the chargeable gain. First, you have to set off your trading losses against the total income of the current year. Then only as the second, you can use the chargeable gain of the current year. So if you want to set off your trading losses against the current year chargeable gain, first you must set off your trading losses against the total income of the current year. Then only you can set it off against the total, then only you can set it off against the chargeable gains of the current year. Assume you want to set off your trading loss against the previous year chargeable gain. Then first you must set off your trading loss against the total income of the previous year. Then only you can reach or touch the chargeable gain of the previous year. Chargeable gain of the previous year. So you cannot directly use your chargeable gains of the current year or the previous year first without using the total income of the current year or the previous year. So if you want to use a chargeable gain of the current year, first use the total income of the current year. You don't have to consider the previous year. If you want to use the previous year chargeable gain, first use the previous year's total income. You can ignore the current year total income. First use the previous year total income, and then you can use the previous year chargeable gain. So this is how you should use the relief against your chargeable gains. Remember that. All right. Then what are the other reliefs available? You have only the terminal loss relief, relief against the total income of the current year and or the previous year, relief against the chargeable gains of the current year and or the previous year. No carry forward relief, no opening year relief, as this is not a newly started business. It's a business we are going to cease trading. So those are the answers for part B and part C. So the answers I have shared anyway, so you can go through those answers as well. And towards the end, I will give you my email address and contact details. So if you need any further clarifications, you can contact me, or you can even come and meet me for any further clarifications. But anyway, I have shared all the answers for these questions. But if you don't understand the explanations given, you can even talk to me. Now, I have very restricted time that has been allocated. Won't be able to explain COPE tax in detail, but I will give you an introduction to that area as well. There are few questions that you have been given from incorporation from corp tax as well. Now, this is a complete opposite of the income tax, individual income tax computation. So anyway, I will take I will go through question number 14. That is a trading loss question for a company, trading loss relief question for a company. So we will be able to make a comparison. Now, you have to be very cautious at the exam when you're dealing with a question, especially a loss relief question. First of all, identify the taxpayer. Is it an individual? Is it a company? If it is an individual, the trading loss relief that is available actually very broader. There are so many reliefs available, such as opening year relief, terminal loss relief, relief against total income of the current year and or the previous year. Then the carry forward relief is there. Relief against chargeable gains of the current year and or the previous year are also there. But when it comes to a company, trading loss relief is restricted. However, recently they have made an attempt to make it little broader as well, especially with regard to the carry forward relief. Now, when it comes to a company, there's nothing called opening year relief. There's nothing called relief against chargeable gains. A company is actually having three main reliefs. One is the carry forward relief. Number two, relief against total profit before QCD of the current year and the previous year. It doesn't say and or. For a company, they can carry forward their trading losses. That's one option. Other relief is relief against total profit before QCD. QCDs means qualifying charitable donations. Now, unlike an individual, when you are calculating the taxable income for a company, actually, a company has a taxable profit. For individuals, we have two separate computations for taxable income and for taxable gains. But for a company, we don't have two separate computation for taxable income and for taxable gains. Both are included in one common computation. We call it TTP computation, taxable total profit computation. Therefore, for a company, when you're calculating taxable total profit, we include income and capital gains both. We include, a company doesn't have employment income, but normally a company has a main income, which is the tax adjusted trading profit. So they have the tax adjusted trading profit. They can have savings income. They can have property income. But remember, for a company, dividend income is an exempt income. If a company has a dividend income, that is an exempt income. So on which we don't have to, on dividend income, we don't have to pay taxes. So trading income, property income, savings income, and miscellaneous income such as royalty charges, royalty payments. So in addition to that, remember, even chargeable gains are added to these income. Chargeable gains are also taken into consideration. So when you add everything together, please look at the PowerPoint presentation with regard to the pro forma. In that, since I don't have time, I will quickly explain these things for you to get a brief understanding. So you have property income, trading income, then you have savings income, but dividend income is an exempt income. If you have a capital gain, add that also to these income. Then you get an answer, we call it total profits. We call it total profits. From this, you can deduct one item, we call it qualifying charitable donations. If you have made a donation to a charity that can be deducted, we call it qualifying charitable donations. When you deduct it, you get an answer. That is what we call TTP, taxable total profit. However, the loss relief that I was referring to, they are available against total profits before QCD. They are not available against TTP. They are available against total profits before deducting qualifying charitable donations. If you look at the carry forward relief, recently they changed the relief. Normally, little while ago, we learned for an individual, carry forward relief means what? You have a trading loss, you carry forward and set off against future available trading profits only. You set it off against future available trading profits. But excuse, for a company, when you use the carry forward relief, you can carry forward the trading loss and set off against the future available total profits before QCDs. Total profits before QCDs. Total profits before QCDs. And there's one important thing, you can decide how much you want to set it off against the total profit before QCDs. You can decide the amount you want to set off against future total profits before QCDs. You don't have to offset the maximum possible amount. You can decide the loss that you're going to set off against the total profits before QCD. Therefore, you can do it in such a way without wasting your QCDs. But if you look at the relief against total profits before QCD of the current year and the previous year, there's no flexibility. Maximum possible amount must be set off against the total profit before QCD of the current year first and then the previous year. There is no flexibility like for individuals and or current year and or the previous year. For a company, it's the current year first and then the previous year. For an individual, current year and or the previous year. But for a company, I'll repeat again, first against total profit before QCDs of the current year, then only you can use the total profit before QCDs of the previous year. Straight away, you can't go to the previous year. And there's no flexibility, maximum possible amount you must set off. Then the third and only relief available for a company is a terminal loss relief. But this terminal loss relief is little different from an individual. For an individual, when we have a terminal loss, we were able to carry back 3 years to set it off against trading profits only. But if a company has a trading loss during the last 12 months of trading, it can be set off against the current year total profit before QCD, and you can carry back 3 years to set off against total profits before QCDs. It's not limited to trading profits only. For a company, when you use the terminal loss relief, you can carry back 3 years or 36 months, and it can be set off against the total profits before QCD. So we'll look at question number 14 now. Uncut, Undergrowth Limited. Required, question number 14, 1-4. Calculate the taxable total profit for all years in the question after using the trading losses in the most beneficial way as soon as possible and claiming any other reliefs. Show any balances carried forward. Okay, so if you look at question number 14, we'll look at the answer. With this question, I intend to conclude the F6 revision session. I wish I could take more time and explain more questions during this limited time period, but the time is a constraint here. So within this time period, I was able to explain some of the important aspects in this F6 syllabus. Anyway, uncut undergrowth limited. The first thing that we are required to do is, for each period of account, we are required to calculate the total profit. The good news is, unlike for individuals, there's nothing called basis of assessment rules for a company. There's nothing called basis of assessment rules for a company. A company has something called a chargeable accounting period. A company pays corp taxes. There are no basic rate bands, higher rate bands, additional rate bands like for individuals. A company has a chargeable accounting period, but that chargeable accounting period can never exceed 12 months. When you're preparing accounts, when you're preparing or when you're calculating corp tax for a company, you must remember a chargeable accounting period cannot exceed 12 months. Therefore, if you have prepared accounts for more than 12 months, if you are preparing accounts for 12 months, more than 12 months, if you are preparing accounts for more than 12 months, in that case, you need to split your period of account to two separate chargeable accounting periods. This is in addition to the question that I'm discussing. So remember, corp tax is calculated for each chargeable accounting period, which cannot exceed 12 months, but it can be less than 12 months. So if you have prepared accounts for 15 months, first 12 months should be taken as one chargeable accounting period. Balance 3 months should be taken as another chargeable accounting period. Currently, the corp tax rate applicable is 19%, and that is for the financial year 2018. Remember, unlike for individuals, for a company, there's nothing called a tax year starting on the 6th of April and ending 5th of April. A company has a financial year. Currently, we are in the financial year 2018. Financial year 2018 starts on the 1st of April 2018, ending 31st March 2019. We don't call it financial year 2018-19, we just call it financial year 2018. It starts on the 1st of April 18, 1st of April 18 and ending 31st March 2019. So financial year 2018, 17, 16, for all those tax year, all those financial year 2018, 17, the tax rates have been unchanged. It's 19%. Anyway, now look at the question. So we have been given the periods of accounts, the chargeable accounting periods, year ended 31st December 2015, 16, 17, 18, and 19. So if you look at the answers, you can see year ended 31st December 16, 15, 16, 17, 18, and then the forecast results for the year ended 31st December 2019. So take all the income, trading profit, 100,000, 30,000, and you can see for the year ended 31st December 2017, there is a loss of 35,000. And for the year ended 31st December 2018, there is a loss of 362,500. And then there's a forecast trading profit of 87,000 pounds. Then interest income, loan interest income, 15,000 and 22,000. Then we have bank interest income also 20,000, and you have recorded accordingly. It's all these information are given in the question. So property income is there. Chargeable gains are also there. However, on the 1st of January 2015, there were no trading losses brought forward, but 40,000 of the capital losses brought forward were available. So when you started on the 1st of January 2015, there were no opening trading losses brought forward, but there was a capital loss of 40,000 brought forward. Capital loss of 40,000 brought forward. Now that capital loss brought forward must be set off against the first available chargeable gain. Remember, if you have a capital loss, it can only be set off against another chargeable gain of the current year. If not, you have to carry forward and set it off against the first available chargeable gain. So there was a brought forward capital loss of 40,000. For the year ended 31st December 2018, there was a chargeable gain of 30,000 pounds. However, we had a capital loss brought forward of 40,000 pounds. So then from that 40,000, we have to set off 30,000 against that chargeable gain. For the year ended 31st December 2018, still there's an unrelieved loss of 10,000 that we can carry forward and set off against future chargeable gain. So you can see that computation here given. So this is that computation. Then we have to deal with the trading losses. So we have calculated we have calculated the total profits for each period. For the year ended 31st December 2017, there is a loss of 35,000. There was a loss of 35,000. And here, that is this 35,000. And then for the year ended 31st December 2018, there is a loss of 362,500. If you take the year ended 31st December 2017, the question wants you to claim the loss relief as early as possible. The question wants you to claim the loss relief as soon as possible. Therefore, carry forward relief should be the last resort. For you to get the relief as early as possible, then you should consider the carry forward relief as your last resort. Terminal loss relief is anyway not available. This is an ongoing business. Then you have only one other option available. If you want to get the relief as early as possible, then you have one option as a company, that is the loss relief against the current year first and then the previous year. So now you have 35,000. Then what you can do is to get the relief as early as possible, this 35,000 can first be set off against the total profit before QCDs of the current year and any unrelieved amount against the previous year. You can't directly go to the previous year. First against the current year. First against the current year. So in the current year, so the losses for the year ended 31st December 2017. The losses for this year. For the current year, total profit is only 15,000. So from the loss 35,000, first you have to set off 15,000 here. And any unrelieved amount can be carried back to the previous year. So first against the current year, then against the previous year. You can't change the order here. So that's how you can get a relief for that 35,000. Then in the next tax year, in the next period of account also, you have a very higher loss. 362,500. Again, we can use the same approach. First, against the total profit before QCDs of the current year, and then any unrelieved amount to the previous year. So we'll see what are the options available here. So first, against the current year. So now this is the loss-making year. Current year total profit, £22,000. Maximum possible amount you have to set off. Any unrelieved amount you can carry back. But the problem is, in the previous year, you do not have any total profits remaining. So only 22,000 can be relieved. So out of 362,500, in the current year, you can set off only 22,000. Previous year, nothing. Therefore, there is a balance of 340,500. What you can do with that? You can carry forward this 340,500 and set off against the future available total profits before QCDs. So when you have unrelieved amounts, trading losses, you can carry forward and set off against future available total profits before QCDs. But the good news is, when you carry forward, you can set off against future available total profit before QCD in the way you want. You don't have to set off the maximum possible amount like we did here. We had to set off the maximum possible amounts here. We didn't have the flexibility. Outcome was, if you have any QCDs, they can be wasted because you have to set off the maximum possible amount. When you set off the maximum possible amount, even though you have a QCD, you won't be able to use it because already total profits have become zero. But if you go for the carry forward relief, good thing is you don't have to set off the maximum possible amount. You can decide how much of your trading losses should be set off against total profits before QCD. Therefore, you can do it in such a way without wasting your qualifying charitable donations. The problem with regard to QCDs are, if you don't use it in a given period of account, it will be wasted. You can't carry forward, you can't carry back. But if you have a trading loss, even though you don't use it, you can carry forward and use it in the future. So anyway, now you were able to use only 22,000, the maximum possible amount. Previous year, we couldn't use anything. Current year and the previous year's QCDs were wasted. Still, there is an unremaining loss out of that 362,500. Then it can be carried forward to set off against future available total profits. Now you would see the future available total profits is 97,000. If you want, you can set off the full amount, 97,000. But we have only set off 96,000 pounds. Why have we done that? Because if you set off the full amount, 97,000, then you will waste your QCD. But in this particular way, against 97,000, we decided to set off only 96,000 pounds. 96,000 pounds. Only 96,000 pounds we decided to set off in such a way without wasting QCDs. Therefore, we had a balance of 1,000 pounds. And that 1,000 pounds, we were able to use it against our QCDs. So by doing that, I did not have to waste my QCD. Didn't waste. So please do have a proper understanding with regard to any type of trading loss relief question with regard to individuals and companies. So when you do that, you will see 96,000 we set off, and there is an available balance of 244,500, which is the answer for part B. So anyway, this is the time period that now we have come to an end of this F6 revision session. We started yesterday, and during this little time period that we were allocated, we were able to discuss some aspects of capital gains tax, inheritance tax, individual income tax computation, in particular with regard to employment income and tax adjusted trading profit, and especially loss relief questions pertaining to both companies and individuals. So on the 3rd of December, when you're sitting for this paper, make sure that you have done your pre-preparations before the exam, and where you are required to do more and more questions from the revision kit. And you have to have a good understanding with regard to the main areas in the syllabus. As I mentioned, capital gains tax, inheritance tax, value-added tax are not very bulky compared to corp tax computation and individual income tax computation. So within that small time period remaining, you can definitely cover capital gains tax, inheritance tax, and value-added tax fully. You have enough and more time for the exam. And then when it comes to individual income tax computation, that is the bulk of the syllabus, but there also we have to mainly focus on employment income and trading income computation, including capital allowances, basis of assessment, and the trading loss relief. And most of the concepts that we learn for individuals, we can apply as it is for companies as well, especially when you are doing the capital allowance computation and tax adjusted trading profit computation. And the loss relief, they are not the same, but they are, you can make a comparison and can have a better understanding. Even the chargeable gain computation is very much similar to individual CGT computation, though a company is not subject to CGT. Anyway, so I wish you all the very best for your exams, not only F6, for all the other papers that you intend to sit, and wish you guys simple and easy examination in December. But always remember not to make blunders, because making blunders, especially in a situation where you have studied really hard, and there, if you do not focus within that time period that you have been given, and they are make a blunders, you will have to regret for the lifetime. Therefore, do not make any blunders. Read the question very carefully. Have a plan in your mind when you're going to answer the question. As I mentioned, if you need any further clarifications, I'll give you my contact number. It's 0718 508836. You can call me on this number for further clarifications. You can even come and meet me at my institute. And my email address is jrj.attorney@gmail.com. So guys, once again, wish you all the very best for your future exams. Thank you very much. So I'll sign off from this F6 revision session, and I would like to thank ACCA Sri Lanka for giving me this opportunity and providing this wonderful platform and the facility to have a direct communication with our ACCA students. And special thanks goes to Amrit, who has been coordinating throughout this time period. Thank you very much. Wish you all the very best again, guys. Good luck.